Welcome back, everyone. This last week has been packed with action. Earnings season is in full swing and we've seen some big names releasing their results. But that's not all. I'm also making some strategic portfolio adjustments, including completely exiting my Apple position and trimming my Alibaba holding. I'll go over my reasoning for these trades later in the video, so stay tuned to hear more. To analyze these companies, I'll be using my investment analysis platform, investmenthorizon.io. The link is in the description if you'd like to try it out. It goes a long way to supporting this channel. Now let's kick things off with major earnings announcements and see which stocks have made the biggest waves this last week. To date, some of the big names we've seen release earnings have included Boeing, AbbVie, Comcast, Starbucks, Intel, MasterCard, Tesla, Microsoft, ServiceNow, Meta, and Apple, just to name a few. Some of the most notable stock moves include AbbVie, which jumped 6% on strong pipeline updates, Comcast, which dropped 10% due to subscriber losses, Starbucks, which jumped 9% due to a beat on their revenue expectations, IBM, which surged 15%, reflecting investor optimism about its cloud transformation, Intel, which slid 6% due to weaker than expected guidance, Meta, which gained 10%, smashing ad revenue expectations, and Apple, which climbed 5% on better than expected earnings. Beyond the earnings releases, there have been some other big movers this week. Alibaba is up 9% on news of its own AI initiatives and a broader rally in Chinese stocks. Fortinet, Google, Costco, and Amazon are each up between 5 and 6%, reflecting positive market sentiment during the earnings season so far. And Nvidia is still trading down from its all-time highs following the release of China's DeepSeek AI platform, though there's growing skepticism about DeepSeek's claims of ultra-low development and model training costs. Now let's talk about my latest portfolio move. I've decided to completely exit my Apple position, so in the next week you'll see this investment drop out of my portfolio. But before I dive into my reasoning, let's take a look at what legendary investors like Warren Buffett and Peter Lynch have to say about when to sell a stock.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
We have a novel element for many investors today in the trust issue.
Yes.
We also have security problems that we didn't traditionally have in America. Have they changed the way you pick and believe in stocks?
No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because the earnings have been terrible.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. Yeah. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down. Yeah. Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you ought to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Because stocks are risky. I mean, look at how much we lost in AT&T. Look how much we lost in Xerox. These were quality companies. You know, you can lose a lot in a stock. So you ought to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple.
Best thing to do is buy a stock that you don't ever want to sell. I mean, that's what we're trying to do. And that's true when we buy an entire business. I mean, we've bought all of Geico, or we bought all of See's Candy, or the Buffalo News. We're not buying those to resell. I mean, what we're trying to do is buy a business that we will be happy with if we own it the rest of our lives, and we expect to with those. It's the same principle applies to marketable securities. You get extra options with marketable securities. You can add to holdings, obviously easier. We can never own more than 100% of a business, but if we own 2% of a business and we like it at a given price, we can add and have 4 or 5%. So that's an advantage. Sometimes if we need money to move to another sector, like we did last year, we will trim from some holdings, but that doesn't mean we're negative on those businesses at all. I mean, we think they're wonderful businesses or we wouldn't own them. And we would sell, if we needed money for other things. The Geico stock that I bought in 1951, I sold in 1952. It was, went on to be worth 100 or more times before the 1976 problems, 100 or more times what I'd paid. But I didn't have the money to do something else. So you sell if you need money for something else. You may sell if you believe that valuations between different kinds of markets are somewhat out of whack. And we have done a little trimming last year in that matter. But that could well be a mistake. I mean, the real thing to do with a great business is just hang on for dear life. Charlie?
Yes, but the sales that do happen, the ideal way is when you found something you like immensely better. Isn't that obvious? That's the ideal way to sell.
And incidentally, the ideal purchase is to have something that you already like be selling at a price where you feel like buying more of it. I mean, we probably should have done more of that in the past in some situations. But that's the beauty of marketable securities. You really do. If you're in a wonderful business, you do get a chance periodically maybe to double up in it or something of the sort. If the stock market were to sell a lot cheaper than it is now, we would probably be buying more of the businesses that we already own. They would certainly be the first ones that we would think about. They're the businesses we like the best.
From these clips, we can see that some of the key reasons to sell a stock include the following scenarios. Firstly, where valuations are stretched and no longer make sense. Secondly, if you can find a better opportunity that offers greater upside. And finally, if the company's performance no longer meets your expectations. Now, I've held Apple for about 2 years, and in that time, I've done well locking in a roughly 50% return. But here's why I'm closing the position. So when I initially bought Apple, I expected higher revenue and free cash flow growth. However, Apple's revenue and free cash flow have only grown around 5% on average annually over the last few years, far below what I'd prefer for a long-term investment. I also think that the valuation looks stretched. While Apple's stock price has surged 700% over the last decade, I think a large portion of this has been driven by multiple expansion rather than actual growth in the underlying business. The price to free cash flow ratio is now at an all-time high, near 4 times higher than where it was 10 years ago. Meanwhile, free cash flow per share has only grown around 5% per year, not exactly explosive growth. I think that there are better risk-adjusted returns in other companies. Comparing Apple to Qualcomm, for example, when we scale Qualcomm's fundamentals to be comparable to Apple's, we see that both companies have similar revenue, earnings, and free cash flow growth over the past decade. However, Apple's stock price has risen 700%, while Qualcomm's has only gained 150%. Part of this is due to Apple's multiple expanding 4 times, while Qualcomm's multiple has actually decreased. Similarly, comparing Apple to MasterCard, we can see that MasterCard's growth has outpaced Apple's, yet Apple's stock is now being rated at a higher multiple. Looking at what Warren Buffett is doing with his Apple investment, we can switch over to Dataroma, and we can see that Warren Buffett currently holds 300 million shares of Apple. But just a year and a half ago, he held nearly 1 billion shares, meaning he's trimmed his position about 70% in this time. At last year's annual shareholder meeting, Buffett attributed the selling to tax reasons, saying he wanted to realize gains now before potential tax increases. However, I'm a bit skeptical about this reasoning. Buffett is famous for holding great businesses indefinitely. He's not selling out of his other major positions like American Express or Coca-Cola. Plus, he hasn't been aggressively redeploying that capital from the sale of these Apple shares. To me, I think the valuation concerns are a bigger factor than he's letting on. At the end of the day, I think Apple is still a good company, and if it shows signs of accelerating growth that align with my expectations, I may consider re-entering a position in the future. But right now, I see better opportunities elsewhere, and I'll be redeploying this capital into a new investment soon, so stay tuned for that. Next up, I'm trimming my Alibaba position. Although I still believe the stock is undervalued on a price to free cash flow basis, its growth has noticeably decelerated over the last few years and is not performing in line with my initial thesis on the business. Rather than waiting for a full market re-rating, I see better opportunities elsewhere to deploy this capital. Additionally, reducing my stake in Alibaba helps offset the gains from selling my Apple shares, keeping my net gain from the sale of these two companies close to zero for tax purposes. After the sale, my remaining Alibaba holding will be just under $1,000. That's it for today's video. Stay tuned to see what I'll be using these funds to buy next in an upcoming video. As always, if you enjoyed the content, don't forget to like, subscribe, and hit that notification bell so you don't miss our next video. See you in the next one.